Good morning, Farm and Ranch. Today we're going to go over just one little table that's in the textbook, and then I'm going to give you 5 accounting transactions and how they would be recorded in an accrual system. And I'll show those transactions, and we'll briefly talk about how they would be recorded in a cash transaction. So number 1, so page 20 in the textbook has this table. There you can see it. It is a comparison of mid-sized grain farms in Kentucky. Grain farm in Kentucky, grain farm in Iowa, grain farm in Nebraska, kind of the same thing. And it's showing the average of the highest third and the average of the lowest third. And that's a pretty common designation to divide into thirds. But what it's really saying is, so if this is your worst performer and this is your best, I have the lowest, the middle, and the top, and it's saying what's the average of the lowest third and what's the average of the best third. It makes sense. We're not saying, hey, what's the worst performing farm in Kentucky? What's the best performing farm in Kentucky? There's a lot of chance that could go into that, but instead we're looking at, hey, what does it look like to be kind of an average farm in this bottom third? What does it look like to be an average farm in this top third? And the point that the textbook is trying to make is that the difference between the top and the bottom is just management skill. That's it. I actually know the authors. They're not trying to pull a fast one on you, but they probably picked this on purpose. Gross farm returns, or what are our overall revenue, about the same. My return to management, which is a profit-like measure, is wildly different, $340,000 to just $800. So this is the difference between having a lucrative career in farming and basically paying yourself wages. That's it. Return to management of $840 means that you've paid yourself your $14 an hour for labor and made nothing else on top of that. That would be a rough way to live. Net income is a percent of gross. Again, that's going to be a measure of profitability. But then we see crop acres farmed and months of labor utilized are nearly identical. One of the great things about this class is we're going to understand through a financial and economic viewpoint that your debt status, so whether you're someone who's been given a farm or someone who's borrowed 80% of the farm's value to operate it and have interest expense while others don't, there are ways to equalize those things. Our measurements keep that into account because we're trying to measure performance. That's what Chapter 3 really gets us into. So same thing with the quality of our farmland. These things can all be adjusted. So I just want you to keep in mind that those things have already been taken account in Table 2.1. Yeah, 2.1. That management skill really is the defining difference between being in that top third and being in the bottom third. Okay, some accounting transactions. So I want to start with a place of agreement. If you went to the bank and the bank said, hey, I'd like to see the farm's balance sheet. The balance sheet is really going to be the same whether we are utilizing a cash system or an accrual system. Your assets, what you own, your debts or liabilities, what you owe, they're really going to be the same thing. Okay, so when we go through these 5 transactions, we can ask ourselves, how would that change the balance sheet? And it's going to be the same whether it's from a cash or accrual standpoint. So we are looking at the same reality. We're just trying to accurately reflect it to make decisions as best as we can. Okay, so my 5 transactions. The first one. Purchased fuel with cash $100. That's a pretty easy one. And I always say with accrual accounting or double entry accounting, start with what you know. You know, if you're like, gosh, I don't know what to do with this transaction, start with the part that you are certain of, which is to credit cash for $100. Cash has a debit balance. If we credit it, that makes it go down. I'm spending $100 to buy fuel. Why are you buying fuel? Because you're operating. I have fuel expense for $100. If this were a cash system, we'd make a cash entry because we're paying with cash. What's happening to our net worth? What's happening to the balance sheet when this happens? Well, cash is an asset whereby fuel expense really isn't. And given that we're putting $100 worth of fuel in the tank, we're going to use it right away. This actually harms our balance sheet in the very short run. Why would we buy $100 worth of fuel? Obviously to produce. We're going to try to use this $100 of fuel to aid us to produce something that ends up returning this $100 and then more. But from a standpoint of the accounting transaction, my double entry system, pretty straightforward. I'm recognizing expense, a cost of doing business, and I'm lowering an asset. The second transaction, I'm going to purchase fuel on account. So there is a gas station that you have an account that you pay monthly or quarterly, and you just fill up and they put it on your tab. Well, let's start with what we know. From number 1, this is now number 2, I know I have a fuel expense of $100. I'm recognizing that expense because it's happening right now. I'm using that fuel currently to produce. But now I have to come up with something with a credit balance to offset this $100. We have an account payable. We create a liability. So we pay for this expense with a liability as opposed to paying for it with an asset. It balances $100 on the left or debit side, $100 on the right or the credit side. It's just the difference between paying with cash or paying with a liability. From the standpoint of the balance sheet, it does the exact same thing. It harms our balance sheet. Can we put fuel expense on our balance sheet? No, we're burning it up. It's not an asset really, it's gone. Is this going to be on the balance sheet? You betcha. That's going to harm our balance sheet by $100 in the same way that lowering cash by $100 harmed us in number 1. But hopefully, again, we're using the fuel to run the pickup or to run the tractor to produce something that returns more than $100. All right, number 3. Purchased equipment for $40,000 with cash. Well, let's start with what we know. If I used cash, my cash balance is going to go down by $40,000. But in return for that $40,000, I have increased the amount of a different asset, equipment, $40,000. Now, one of the beauties of an accounting system and being your own accountant is you can decide, do I want to have general equipment? Do I want to have grain equipment? Do I want to have livestock equipment? You can have as many accounts as you want for each individual item would be a likely scenario. Okay? So I lower one asset, cash. I increase another asset, equipment. From the balance sheet perspective, nothing has happened. Now I know that there's someone out there that's saying, yes, Tim, but that equipment will depreciate. We'll recognize that later on. That's called depreciation expense. That's a cost of doing business. And we do have a way to recognize that. It's very important. Okay, that's number 3. Number 4, purchased equipment for $40,000. $10,000 with cash, or otherwise known as a down payment, and a $30,000 equipment loan. Okay, so we don't, maybe we have $40,000, maybe we don't, but there's a loan. Maybe the interest rate is very, very low, and that's enticing you to borrow the money. You've purchased the equipment, you've given them $10,000, and in return you have a $40,000 asset. So let's think about what we know for sure. Well, we know for sure that equipment is going to increase by $40,000, just like it did before when we bought the equipment with cash. We also know that our cash balance is going to go down by $10,000. We paid 10 grand. But we also utilized a $30,000 loan to pay for the rest. And we would call that a note payable, or we just call it an equipment loan. Difference between a note and an account payable: a note payable is a liability that's typically longer than a year, and account payable is less than a year. We're on the hook for $30,000. So we call it double entry accounting, but really we have 2 credit entries and 1 debit entry, but we still balance. From a standpoint of the balance sheet, again, it's exactly the same. My assets have gone up by $40,000, then they went down by $10,000. Oh, by the way, my liabilities increased by $30,000. I'm exactly at the same place that I started. Think of it this way. If you purchased the equipment and before it was, so you made the entry, you purchased it, but before delivery was made, you decided, nope, this was the wrong one. Now, before delivery is made, the transaction isn't complete, but you've gone ahead and made the accounting transaction, and you call the implement dealer and you say, hey, I'm sorry, I made a mistake. I can't take delivery. This just undoes itself, right? They give you your $10,000 back. You don't owe them $30,000, and you don't have the piece of equipment. The balance sheet is unchanged. Going forward, we have other ramifications, but for now, there is no difference. All right. So that was our 4th transaction. Our 5th transaction paid equipment loan, or made equipment loan payment. Made equipment loan payment, $700, $600 to principal, $100 to interest. Okay, this is where we can get into some of our subtleties of what's happening when we borrow money. When you borrow the $30,000 immediately, if you pay them back that same day, do you owe them any interest? No, because no interest has accrued. And we can't recognize that interest until you actually owe the interest, and when you make the payment is when that can be done. So in this case, start with what we know. We made a $700 payment. Cash goes down by $700. We also know that the amount that we owe them is going down by $600. That's what made to principal means. So we had that note payable equipment from number 4 that had a $40,000 credit balance over here, we're going to lower that by $600. And we're going to keep lowering it until there's nothing left. But we have $100 left out there that's not balancing us, or that we're not balanced. Interest expense, $100. And the final thing that I'll say today is this will give us some insight into the difference between profitability and cash flow. The cost or the expense of this equipment, of this payment, is not $700. If we look at this payment, this $700, $600 of which paid down a liability, that's a balance sheet move. On the balance sheet, I'm losing $600 of an asset, but I'm also losing $600 of a liability. So it's like having $30 in your pocket. You have $30 of an asset, but you owe a friend $20. So in the back of your mind, you know that of that $30, it's not all yours. Having $10 and no debt is the same as having $30 and a $20 debt. So the balance sheet just, hey, nothing has really happened in terms of the standing of the business. However, the interest expense, that extra that you pay, counts against profit. Okay? So this harms our profit by $100, but it doesn't harm our profit by $600 or $700, but there certainly is a cash flow implication to making a principal payment. And that's something that we will continue to unpack as this course goes on. All right, as a reminder, you should be through chapters 1, 2, and 3. There's an assignment that is due tomorrow at 11:59, and there'll be a quiz on Friday that you can take at any time. Once you open it, you have an hour, open book, open note. There's also Zoom tomorrow. So hope to see you then, and hope you found this 17-minute video worth your time. Thanks.